Global banking institutions invest billions in sophisticated monitoring software every year, yet illicit finance continues to freely circulate through the system. We are watching a structural failure, where the foundation of transaction monitoring is collapsing under the weight of high-speed laundering. In October 2024, TD Bank faced a $3.09 billion penalty. Over a 6-year period, $18 trillion moved through its U.S. operations, largely unchecked, allowing a single cartel to easily wash hundreds of millions. The core procedural breakdown driving this is the interdiction gap. Money moves across international borders in milliseconds, but suspicious activity reports, the primary tool banks use to flag these transfers, are typically filed 30 to 60 days later. By the time compliance officers assemble the paperwork, the funds have already passed through multiple jurisdictions, completed currency conversions, and settled into irreversible assets like crypto or real estate. When the paperwork arrives weeks after the money is gone, financial institutions cease to be preventative gatekeepers. They are reduced to recording the history of their own exploitation. Looking at this flowchart, we see the defect at the base of the global financial network. It operates as a brittle, binary state machine. Every transaction is forced through a gate that must categorize it as either allow or deny. High-volume financial environments prioritize liquidity. When a transaction exhibits probabilistic risk, a gray area where it isn't perfectly clean but not obviously illicit, the system's need to prevent friction forces it into the green allow box. Uncertainty defaults to permission. Professional laundering syndicates map these thresholds. They engineer transactions to hover exactly in that ambiguous zone, deliberately remaining just below the hard block limit to guarantee the system will fail open. For the human compliance teams inside the banks, this creates an operational nightmare. The system floods them with false positive alerts, forcing analysts to manually guess whether to approve or block thousands of ambiguous transfers under extreme time pressure. In a binary environment, an alert is a weak signal that gets ignored to keep the market moving. The structure takes the ambiguity of global finance and converts it directly into a systemic vulnerability. This state machine diagram introduces ternary logic, built on 3 states: proceed, refuse, and the 0 epistemic hold. Focusing on the central orange node, the epistemic hold is a system-enforced pause. When an unresolved verification gap is detected, the transaction is trapped here. The bottom sequence demonstrates how the 0 state attacks laundering. It physically interrupts the transfer layer, blocking velocity. This text box shows the impact. A 6-hour chain becomes a 72-hour window, giving law enforcement the gap to freeze assets before they disappear. Uncertainty ceases to be a loophole that forces approval. It becomes a deterministic barricade that halts movement until proof of legitimacy is established. But pausing transactions creates a massive engineering challenge. Modern finance requires sub-millisecond settlement speeds. Deep evidentiary verification is computationally heavy. This schematic outlines the solution: a dual-lane latency architecture distributing the computational load. The upper green block defines the inference lane. It executes synchronously in under 2 milliseconds, assigning the proceed, hold, or refuse state without dragging down standard processing speeds. But it operates under an absolute physical rule: the no log equals no action protocol. The settlement instruction cannot proceed until a cryptographically bound decision log is generated. Looking at the lower blue section, we see the governance lane operating asynchronously. It takes up to 500 milliseconds to enrich the log, seal the evidence, and batch it, ensuring the heavy documentation doesn't interrupt the immediate financial transfer. By strictly separating the immediate state decision from the heavy documentation process, the architecture secures millisecond transaction times, backed by immutable evidence. Software holds only work if humans respect them. The ultimate vulnerability is the silent override, when an executive manually forces a halted, highly lucrative transaction through the system. To neutralize the insider threat, the architecture uses a hybrid shield. A single compliance officer or executive credential cannot bypass an epistemic hold. The system demands multi-signature authorization, requiring keys from geographically separated custodians. This timeline charts a permanent chain of custody. Manual overrides permanently bind the executive's identity, timestamp, and justification to the transaction log. As the green box notes, this log serves as courtroom admissible evidence, creating an inescapable trail of legal liability. The network functions as a physical trap for illicit wealth. Securing accountability directly at the execution layer, the architecture prevents the movement of unverified capital.